Yo, it's currency theory. Let's just get right to it. But first, I have to say, nothing in this video is financial advice, and I'm not a financial advisor. So, to understand why I think the everything bubble's going to pop, probably this year, almost certainly under this administration, we have to understand the framework I'm working with. Now, while I was studying finance at university, I was taught a formula, which is actually incorrect, and I'll show you the correct version here soon. But this formula was MV equals PY, and that stood for money supply times velocity of money equals price times output. Now, output referred to GDP, or gross domestic product. So everything produced within the last year or quarter, usually, but everything produced over a given amount of time. And intuitively, it made sense. And here's why. So I think most people watching this video understand that more money chasing a given amount of goods drives prices up. Now, velocity of money refers to how fast money changes hands. Money changing hands faster is money going further, and money going further is inflationary. The more money is spent, the more frequently it bids up prices. So, if a given amount of money is spent more often, then it will bid prices up, assuming there's also a given amount of wealth to bid on. Now, if there's more goods, then all that bidding is going to keep prices stable, right? So this all makes sense intuitively. Money supply times velocity of money equals price times output. Now the problem with this is since when is money only good for the goods and services produced in a given amount of time? This is incorrect because it should be money supply times velocity of money equals price times wealth, right? Money is not good in exchange for everything that was produced last year or last quarter or whatever. It's good for all the goods and services, right? So money supply times velocity of money equals price times wealth. Now, this is a bit of a side tangent, but I think you'll find it interesting. When I realized MV equals PW and not PY, it's because I was thinking about it. And as I was thinking about it, I realized whoever came up with MV equals PY must have been thinking about it. It was presumably their original thought. How could they have not known better? They must have known better. Why were they trying to deceive people into thinking MV equals PY instead of MV equals PW? And I just started to smell it. I was just thinking, I wonder if the one who came up with this is one of these weirdos from one of these secret societies at these universities that spin all sorts of nonsense. And I was just hoping that it was going to be the one that I'm most familiar with because I read Anthony Sutton's America's Secret Establishment, The Secret Society of Skull and Bones. Well, it just so happens that indeed the guy who came up with it, or really just formalized its mathematical representation, Irving Fisher, was a member of Skull and Bones. A bonesman, as they say. Anyway, so that's why it's wrong. So MV equals PW. Now, that's the first framework I need you to understand. The next one I need you to understand is the debt bubble. So, no matter where you live in the world, all your money comes from a central bank. And each central bank is really just a branch of the entire central banking empire, as I believe was clearly demonstrated in my documentary, Chronicles of Today's Monetary Empire, a reinterpretation of money, history, and economics, which you can find here on my YouTube channel. Now, when these central banks supply new money for the economy, they buy bonds with it. So all of the new money being supplied into the economy is being lent. This means all of the money plus interest is owed back to a central bank. This creates an effect of compounding interest into the wealth of the economy. Now, to show how this process of compounding interest works in detail, I'm going to pull a clip from the documentary I just mentioned. If you've already seen this, you might want to skip ahead. If not, you probably need to watch it to understand my perspective. So now I'd like to give a more detailed explanation along with a visual demonstration of the process we just discussed. Then I'll provide some visual simulations of this process playing out. So, as the debt coming due gets collected, the debt owed to the Fed is reduced by the amount that was collected, and the money supplied by the Fed is reduced by the same amount. So, the debt is reduced at a one-to-one basis with the money. But, because the debt was initially greater than the money, a greater percentage of the money is removed from the economy than that of the debt, causing the ratio of debt to money to increase. Or, to put it differently, there is a portion of the dollar economy that is unpayable debt because there is not enough money to pay it. And as the debt gets collected, the portion of the economy that is unpayable debt increases. This unpayable debt portion of the economy is represented here in red. As this unpayable debt portion of the dollar economy increases, it becomes harder for those who borrow, such as banks who borrow from the Fed and other banks, to acquire the money they need to pay off their debt. This drives the demand for dollars higher, and as demand increases, so does price. And what do dollars cost? Interest. So interest rates will tend towards the unpayable debt portion of the economy, or at least the unpayable debt portion of the economy will be the most relevant variable in regards to interest rates. So when the central bank collects the debt, the unpayable debt portion of the economy grows. This means the demand for money is higher, which means money costs more, which means interest rates are higher. Now, when the central bank increases the money supply, it does so by making bids on debt. And if you're bidding for debt, you're bidding interest rates down, not up. If you don't understand why, just imagine trying to buy a bond from somebody at an auction. If somebody is willing to buy a bond that will pay them 5% interest, and you want the bond more than that person, then you offer to buy the bond for 4% interest. Now, since this monetary system starts with the assumption that money costs interest, and it supplies money by bidding interest rates, then this monetary system also assumes that at the start of said monetary system, the initial money supply starts with an initial interest rate, and therefore an initial debt and debt to money ratio / unpayable debt portion of the economy to go along with said debt. So, building off of those assumptions, if we assume that interest rates will be the same as they were when the money supply gets back to what it originally was, here it was 33, which is just an arbitrary number I selected, then we also have to assume that the unpayable debt portion of the economy will be greater when the money supply returns to its original amount, because the debt equals the money plus the interest the money costs. And when we started to increase the money supply back to its original amount, we were starting with a higher interest rate, which means more interest per dollar was getting added on to the debt than there was debt per dollar initially. So the debt will be higher even though the money supply is the same. But then that nullifies our original assumption that the interest rates will be the same when the money supply returns to the original amount, because interest rates will tend toward the unpayable debt portion of the economy. But of course, the unpayable debt portion of the economy is greater now. So, in order to bid interest rates back down to the original rate, we have to increase the money supply beyond what it was originally. Now, I hope if you're watching this video, you understand that increasing the money supply creates inflationary pressure. So you can see how this monetary system puts us between a rock and a hard place. On the one hand, if you want to get interest rates under control and get the unpayable debt portion of the economy manageable, you end up creating inflationary pressure. And this inflationary pressure will tend to get worse as we go through these collection inflation cycles. So keeping the unpayable debt portion of the economy manageable eventually becomes hyperinflationary. So then avoiding hyperinflation leads to an overwhelming unpayable debt portion of the economy. So when the unpayable debt portion of the economy gets out of hand, either interest rates have to follow or the ratio has to get decreased because the Federal Reserve is decreasing the debt by collecting collateral in the economy at large, which means defaults are occurring across the economy, which causes economic depressions. And here's another look at what it was before we collected debt and after we bought more debt by issuing new currency. Notice only the debt expanded, the money supply is the same. Here I've provided a simulation of the annual progression of the debt and money within the dollar economy. This model assumes no major default and bailout situations that would lead to quantitative easing, and it also assumes no inflation target, such as the Federal Reserve's 2% inflation target. If you're unaware of what quantitative easing is, we'll get to that in a minute. Notice how the debt swallows the money. In this next model, we'll factor in the Fed's 2% inflation target and default crises that lead to quantitative easing. Quantitative easing is simply when the Federal Reserve or any central bank increases the money supply drastically in order to bid down interest rates, often to save the financial sector from collapse. Notice that even with consistent inflation, the debt to money ratio continues to expand. And the only way to temporarily get the debt to money ratio back under control is by printing enough money to create hyperinflation. In these final models, we're going to factor in quantitative tightening and stagflation. Quantitative tightening is when the Federal Reserve or central bank stops lending new currency and only collects the debt for a certain amount of time in order to get inflation under control by shrinking the money supply. Stagflation is when inflation stays elevated for a while. It's usually a result of money changing hands faster throughout the economy. One such example of money changing hands faster throughout the economy would be banks lending cash that they've had in reserves for a while. I hope you see why money changing hands faster drives prices higher. If not, we'll cover this more in depth later. But basically, the further the same dollar goes, the more that dollar bids prices up. So even with the shrinking money supply, you can still have stagflation. Often, central banks will start quantitative tightening because of stagflation. Notice here how quantitative easing not only leads to massive inflation immediately, but also leads to stagflation, which in turn leads to quantitative tightening, which then in turn leads to a rapidly increasing unpayable debt portion of the economy. Here I decided to run the same simulation again, but this time I have the scale size adjusted to the size of the debt bubble so you can see the ratio clearly the whole time. So you see the problem emerging here. The unpayable debt portion of the economy is slowly getting out of control. And to get it back under control, you have to increase the money supply so drastically that you're going to drown the economy in inflation. And the only other way to shrink that red circle and get the unpayable debt portion of the economy back under control is to allow a massive percent of the economy to default on their debt. And either of those two options create economic depressions. But remember, the central bank gets to collect the collateral. Finally, here we have the same demonstration in the form of a line chart. It may take a minute to become visible. So we see here that by design, the dollar economy and the rest of the global economy has either uncontrollable inflation or uncontrollable growth in debt and interest rates. (2008) was a good example of quantitative easing, or QE, where the central banks increased the money supply by many multiples to temporarily save the financial system from collapse. But eventually, the Fed must allow the cascading banking failures, because eventually, attempting to stop this from happening will result in the hyperinflationary collapse of their currency. And for the central banks at the helm of the empire, there is much greater incentive to collect the collateral than there is to risk hyperinflating their currency to death. And the Fed is at the helm. We should not expect the Fed to do the same thing to the dollar that the Central Bank of Venezuela did to their bolivar. The Fed is the command and control center for this global central banking empire, as displayed by the dollar's global purchasing power. The Fed, and other first world central banks for that matter, have a lot more to lose by hyperinflating their currency to death than the Central Bank of Venezuela. And the central banking empire as a whole loses a lot more if the dollar goes down compared to if a less powerful currency, such as the bolivar, goes down. To the central banking empire, the dollar is crucial. The bolivar is scrap. So the Federal Reserve is incentivized to let the cascading banking failures occur instead of risking hyperinflating their dollar to death. Therefore, the collapse of many major banks will result in the disappearance of customer funds, which will spur business defaults, large and small alike, as well as mortgage defaults. And because money's becoming scarce, people will start taking the money they can get out of other markets, causing disappearing investment funds, such as retirement funds, and so on. This is not financial advice. And what you note, in 2019, the federal funds interest rate spiked from the Fed funds target range near 2% all the way to about 10% overnight. And while the Federal Reserve said it wasn't QE, they did increase the money supply drastically in order to bid the Fed funds rate back down to 2%. Because of its relevance to the 2019 credit event, I think it's a good time to note that when a large sum of debt comes due is likely to determine when the financial crisis occurs. So it's the debt due now to money ratio that has the biggest impact on when defaults start to occur or when interest rates start to spike out of control. Indeed, on September 16, 2019, a large amount of Treasury debt came due, and at the same time, corporate taxes came due, so banks removed money from their reserves to pay taxes, leading to an overwhelming amount of debt coming due relative to the amount of money available to pay it, which caused the federal funds rate to spike to 10% overnight from 2%. This means that some banks and financial institutions were so desperate to pay off their debt coming due that they were willing to pay 5 times the expected interest rate in order to borrow money to pay it. Now, the Fed was able to print enough money to bid down interest rates this time, but with each subsequent debt shock to the system, the unpayable debt portion of the economy is likely to be significantly bigger than it was last debt shock. This is because the unpayable debt portion of the economy is continuously compounding, as we demonstrated earlier. And this means it will require a greater percentage increase in the money supply to bid down interest rates each subsequent debt shock. So the next time this happens, the Fed might not be able to bid down interest rates without hyperinflating to zero. Now, before I continue, I need to say I'm apolitical. I don't vote. This isn't me picking either side of the aisle. And I also need to say I love freedom. And if you watched my documentary, you know I love freedom. This is not anti deregulation or pro regulation. This is just relating back to what we discussed earlier and the effect deregulation happens to have frequently given this particular monetary system. So now hear me out, please. Going back to the start of the Great Depression in 1929, looking at the stock market, we see every single major stock market crash happened under a Republican administration, particularly one that deregulated. Now, why is that? Deregulation should spur economic growth. It opens the door for new opportunities. It levels the playing field, makes everything more fair, reduces the cost of regulatory compliance. Despite our stock market observation, deregulation is positively and significantly correlated with movement between socioeconomic classes and increased GDP per capita growth. And that's not just according to the statistical analysis that I was able to get Google to sum up for you on the screen. In my 2 economic policy classes in college, the textbook for the class that argued for more regulation admitted the statistics did not support any of their hypotheses, whereas the textbook for the class that argued for deregulation consistently boasted that the statistics supported their hypotheses. So then why do we see this phenomenon of crashes occurring in financial markets after deregulation? 1929, which was a big one, 1973, 1987, which was small but very fast, 2008, 2020, every single one of those major crashes happened under a Republican administration who deregulated in some way or another. Why would deregulation be so correlated with these crashes? Well, it relates back to MV equals PW. When you deregulate, money starts chasing new opportunities. And as money chases new opportunities, that's increasing the velocity of money. And as the velocity of money increases, so does inflationary pressure. And the Federal Reserve has a public mandate to target 2% inflation. Now, whether or not they stick to that mandate very well is besides the point. They can use that anytime they want to say, we need to get inflation under control. And so what happens is the velocity of money increases and inflation picks up. The Federal Reserve and the central banks go into quantitative tightening or create some sort of scarcity of money. They make money more expensive and reduce the money supply or create some sort of shortage in the money relative to the debt. And when that happens, that's when the unpayable debt portion of the economy overwhelms the money supply, leading to defaults across the economy and financial collapses and all the rest of the economic calamity associated with money shortage. And we have a Republican in office now who's probably going to deregulate in some big ways that will spur the velocity of money, giving the Federal Reserve an excuse to create a shortage of money. So it's almost like deregulation is framed to be the bad guy by this system, which works out well for the central banking empire if they want to control the economy through regulation. Now, the central banking empire controls it enough by having a monopoly on the monetary market, which is half the economy, and compounding interest into the economy at large and funding whatever they want to into existence, basically, with their virtually unlimited purchasing power. But also, from this angle of framing deregulation to be the bad guy, they can control the economy by convincing the people that free markets are bad and that they need more regulation, which grows the government, who's their biggest debtor, and who they control. And so the government can also then continue to help out the central bank and their corporate associates through competitively favorable regulations. And when I say competitively favorable regulation, I mean favorable to specific corporations. Now, another indicator we have that the bubble's going to pop really soon is that a few months after interest rates spiked in 2019, there was an excuse to increase the money supply drastically all over the globe, reliquidating the debt market, inflating the debt bubble one last time, therefore increasing the collateral on the central bank's balance sheet one last time, an excuse to create one more inflation collection cycle that will compound interest into the wealth of the economy one last time. Think about how egregious that scam was and how inflationary it was. And consider the risk return profile of conducting such a move against the population from their end. Because we know it's the tax driven monetary monopoly, aka the central banking empire, that's making decisions on the geopolitical scale. Or at least I hope you know this, and if you don't know this, you should probably watch my documentary here on my YouTube channel, Chronicles of Today's Monetary Empire. But think about how much incentive there must have been there for the central banking operation. There must have been quite some carrot or quite some stick for them to conduct such a scam, because I don't think they can do it again anytime soon. Given the current state of the world's populations, I think it's going to be quite a while before they could play that card again. And if you ask me, it was quite the card. The level of inflation and the severity of the deception make it seem like one of the last plays before the collateral from the inevitable economic collapse gets collected by the central banks. Now, the next thing I want to look at that indicates that the bubble is going to pop soon is the stock market. If we zoom out on the Dow Jones Industrial Average chart, we see that it's forming a giant parabola. And I'm no technical analyst, I'm no chart analyst, but any chart analyst will tell you that a parabola is a bubble. When an asset is forming a bubble, its chart will form a parabola. Now, the bubble's been forming for like a century, so popping soon could be within the next few years. So it doesn't necessarily point to the Trump administration, but when we combine it with the rest of the arguments presented here, it sure seems to point to the bubble's going to pop on the Trump administration. For much better and much more advanced technical analysis, I have to recommend Blockchain Backer here on YouTube, who also seems to think that the bubble's going to pop very soon. Also note that Jim Cramer is very bullish on 2025. If you know, you know. I'll see you in the next one. But before I go, I want to recommend a good read. The book I mentioned earlier, America's Secret Establishment, An Introduction to the Order of Skull and Bones by Anthony Sutton. If you watched my documentary, you know about William Averill Harriman. Well, he was a member of Skull and Bones, and so was Prescott Sheldon Bush, and both George Bushes, and John Kerry for that matter, and many other very powerful men. But yeah, I wouldn't feel right without giving that work a special shout out. Don't forget to like, subscribe, share, comment below, and check out my documentary, Chronicles of Today's Monetary Empire, a reinterpretation of money, history, and economics. Thanks for watching.